Ladies and gentlemen, thank you for being here. I want to invite you right now to take a bird's eye view of our current economic world and ask a tough question. Are we underestimating the true risks to our money, our savings, our future? Because when you peel back the layers, what we see isn't a stable financial structure. It's a house built on shifting sands. You might have heard numbers like 34 Zos, and for gold, 2,000,000 for silver tossed about. That sounds unbelievable, it sounds extreme, but let me assure you they are not wild guesses. They are possible outcomes given where the macro cycle is headed, where deficits, debt, currency printing, and global tensions converge. If you own gold or silver or are considering owning them, this moment demands attention because what you believe about inflation, about stability, about what money is will determine whether you preserve value or watch it erode. When you step back and look at the patterns of history, you begin to see that economies, markets, and societies move in big cycles. They're not random. They follow a sequence that repeats again and again, even if the details change. We're living in the later part of one of those big cycles now, and that has enormous implications for anyone holding money, investments, or wealth in general. The essence of the late stage is that debts have grown so large and obligations have become so heavy that they can't be sustained in the normal way anymore. Governments and central banks, when faced with those realities, almost always turn to the same solution. They create more money. When too much money is created relative to the goods and services in the economy, the value of that money falls. You can see it in the price of groceries, housing, and energy. The cost of living goes up while the purchasing power of each unit of currency goes down. This is what makes hard assets so critical. Unlike paper money, which can be produced without limit, things like gold and silver cannot be printed into existence. They have been valued across cultures and centuries for exactly that reason. They are scarce, durable, and outside the control of policymakers. This shift from soft paper-based money to hard assets happens gradually, and then suddenly in the early phases, people trust the system. They hold cash and bonds believing that those assets will maintain their value, but as inflation eats away at returns, confidence starts to erode. Then in moments of stress, whether it's geopolitical conflict, a banking crisis, or runaway deficits, people rush to what has stood the test of time. And history shows they turn to hard money. The important point is not whether gold or silver is at a particular price today. What matters their role as anchors when everything else is floating. In the late stages of cycles, you see wild swings in currencies, stock markets, and bond yields. It becomes harder to know what is safe. Hard money provides clarity in that fog. It's not about speculation. It's about preservation. If you're thinking in terms of decades, not months, you can see why civilizations from ancient empires to modern nations have always leaned on hard money when the soft systems failed. We are entering a period where the same forces are once again at work. Rising debt burdens, widening deficits, political polarization, and currency devaluations are converging. That makes it critical to step outside of assumptions and recognize the risk of simply holding paper claims. A balanced portfolio acknowledges those risks and allocates accordingly. Hard money doesn't solve every problem, but it provides protection against the vulnerabilities of fiat systems that are stretched to their limits. In times like these, ignoring that lesson from history is one of the costliest mistakes an investor can make. When governments spend more than they earn, they create deficits. To cover those deficits, they borrow over time. As borrowing compounds, the debt stock becomes massive relative to income. That is the position we find ourselves in today, not just in one country, but across much of the developed world. History shows that when debt burdens reach extreme levels, societies always face a choice about how to deal with. There are only a few options: grow faster than the debt, cut spending, raise taxes, default, or print money. Each path has its costs and none are painless. The most common route chosen because it is politically easiest is to create money to cover the gap. This process plays out subtly at first. Central banks step in to purchase government bonds, effectively financing deficits. Liquidity floods the system. For a time, this feels good. Asset prices rise, credit expands, and growth looks healthy. But beneath the surface, the value of money is being eroded. The more currency that is created to cover obligations, the less each unit is worth. In terms of real goods and services, what follows is a cycle of devaluation that impacts everyone who holds that currency. When money loses value, it doesn't happen uniformly. Those closest to the flow of credit and capital often benefit first. Asset owners see their wealth rise as stocks and property inflate. Wage earners and savers whose incomes don't keep pace with inflation fall behind. This dynamic widens inequality, fuels political conflict, and undermines trust in the system. In late-stage cycles, this mistrust grows into something more dangerous. People begin questioning the very idea of a money itself. Currency devaluation is not just about numbers on a chart, it's about confidence. Money only works if people believe it holds value tomorrow. Once that faith is shaken, the system can unravel quickly. See flight into alternatives, hard assets, commodities, or foreign currencies perceived as stronger. That is why gold and silver often rise during these periods, not because they change, but because the measuring stick paper money is deteriorating. History is filled with examples. The decline of the Roman denarius, the fall of the British pound as the world's reserve currency, or that the repeated episodes of high inflation in modern economies all show the same pattern. A too much debt financed by printing leads to devaluation and eventually to a reset of the system. The question isn't whether it will happen again, it always does, but how it will unfold this time. The practical takeaway is straightforward. In a world of rising deficits and mounting debt, the probability of currency devaluation is high. That doesn't mean abandoning fiat money altogether, but it does mean being realistic about its vulnerabilities. A prudent investor looks at the balance of risks and ensures that part of their wealth is protected in assets that cannot be devalued by decree. Because when the tide of paper money recedes, those anchors of real value are what remain. One of the biggest mistakes people make when investing is to think they know what the future will look like. The truth is none of us do. What we can know by studying history and probabilities is that the future will bring surprises. Some of those surprises will be positive, many will be painful, and almost all will be unexpected. The way to deal with that reality is not to bet everything on what you think will happen, but to build a portfolio that can withstand what you don't see coming. That's where diversification comes in. Diversification is not just about owning a mix of different assets, it's about owning assets that behave differently in different environments. Stocks tend to do well when growth is strong and inflation is low. Bonds generally perform when growth slows and interest rates fall. Commodities and hard assets like gold and silver usually provide protection when inflation rises or when there's a loss of confidence in currencies. If you put these pieces together intelligently, you can create a portfolio where the weaknesses of one asset are offset by the strengths of another. That balance is what allows you to navigate storms without sinking. Think of it like insurance. You don't buy insurance because you expect your house to burn down tomorrow. You buy it because you recognize that if the unlikely happens, the consequences without protection would be devastating. The same logic applies to your wealth. If you're all in on stocks and we enter a period like the 1970s, stagnant growth and high inflation, equities alone won't protect you. If you only hold bonds and inflation erodes, fixed income returns, you're exposed again. But if you hold a balanced mix, equities, bonds, hard money, some cash, the odds of surviving intact go up dramatically. The power of diversification is mathematical as much as it is strategic. When assets are uncorrelated, combining them reduces risk without necessarily reducing return. That means you can smooth out the ride, avoid catastrophic losses, and keep compounding over time. The compounding effect is what builds wealth, and avoiding big drawdowns is what allows compounding to continue. People often underestimate just how damaging a large loss can be. If you lose 50%, you need a 100% gain just to get back to even. Diversification is your best defense against that trap. In the current environment, high debt, rising inflation pressures, currency debasement, geopolitical tensions, the need for portfolio insurance is greater than usual. No single asset will save you in every scenario. That the stock market might do well if innovation drives growth, but it won't protect you in a stagflationary shock. Bonds might help if we fall into a deep recession, but they won't hold up if inflation stays elevated. Gold and silver won't always deliver high returns, but they tend to shine when the financial system itself is in question. Putting these together is about predicting, it's about preparing. The goal is resilience. You want to design your portfolio in a way that no matter what the world throws at you, inflation, deflation, boom, you can absorb the blow and stay in the game. That is the essence of good investing. Not being right all the time, but being positioned so that you don't get knocked out when you're wrong. Gold and silver are often mentioned in the same breath, but they are not the same. They play different roles, behave differently, and offer different kinds of risks and rewards. Understanding the distinction between them is essential for anyone looking to hold hard assets as part of a balanced portfolio. Both metals share the quality of being outside the control of governments. They can't be printed, they don't depend on someone else's promise to pay, and they've been stores of value for centuries, but their dynamics diverge in important ways. Gold is primarily a monetary metal. Its main function throughout history has been to serve as money, a reserve asset, and a store of value. It is the asset central banks hold in their vaults, not because it produces income, but because it preserves purchasing power over long periods of time. Its demand is relatively steady and less tied to economic cycles. When trust in currencies or financial systems is shaken, gold tends to attract flows. That's why its price movements, though significant, are generally less volatile than silver's. It is seen as the ultimate safe haven. Silver, by contrast, has a dual personality. It is partly a monetary asset like gold, but it is also heavily tied to industrial use. Silver is critical in electronics, solar panels, medical devices, and a host of other technologies. That means its price is more sensitive to economic cycles and industrial demand. In times of strong growth and innovation, silver can outperform dramatically, but when global growth slows, industrial demand contracts, and silver can underperform even if gold holds steady. This duality makes silver more volatile, both on the upside and the downside. One useful way to understand their relative value is to look at the gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold. Over long stretches of history, this ratio has fluctuated, often reflecting shifts in monetary conditions, supply-demand dynamics, and investor sentiment. When the ratio is high, it suggests silver is cheap relative to gold. When low, silver is expensive. For long-term investors, extreme readings in that ratio can signal opportunities, but trading, it requires tolerance for volatility. Silver can swing widely in short periods. From a portfolio perspective, gold provides stability and acts as a hedge against monetary debasement and systemic risk. Silver, while also a hedge, offers more leverage to certain conditions, particularly inflationary booms or industrial expansions, makes it riskier, but also capable of delivering outsized returns. Holding both can be valuable, but it's important to calibrate allocations to match your risk tolerance. Leaning too heavily on silver means signing up for sharp ups and downs. Leaning only on gold means you may miss some of the explosive upside, can deliver in the right conditions. The broader point is that these two metals are complements rather than substitutes. Gold anchors the portfolio, silver adds torque. Together they provide a blend of safety and potential in a world of rising uncertainty. Understanding that balance allows you to use them wisely, not as speculative bets, but as strategic components of long-term resilience. The biggest dangers in investing and in life are usually the ones we don't see coming. By definition, tail risks and black swan events are rare, extreme, and outside the range of what most people expect. But history shows us that they happen more often than we'd like to admit. Wars, revolutions, debt crisis, hyperinflations, pandemics, systemic financial breakdowns all seemed unlikely before they arrived. And yet, they reshaped entire economies and societies when they did. If you fail to prepare for these possibilities, you put yourself in a position where one extreme event can wipe out years or even decades of progress. Most people are conditioned by recent experience. If markets have been calm, they assume calm will continue. If inflation has been low, they assume it will stay low. That bias is dangerous because it blinds you to the full range of outcomes. Tail risks don't fit neatly into models or forecasts. They appear suddenly, break assumptions, and force rapid adjustments. The key is not to try to predict the exact timing or form of the next black swan. To structure yourself so you can survive it whenever it arrives. One way to think about this is through resilience. Resilience doesn't come from certainty. It comes from balance and redundancy. If all your assets are tied to one outcome, say steady growth with low inflation, then a deviation from that path could be catastrophic. But if your portfolio holds assets that perform differently in different environments, you are better positioned. For example, if equities collapse in a recession, bonds or gold might offset the damage. If inflation erodes the value of bonds, commodities might rise in response. The point is to ensure you are not dependent on any single assumption about the future. Another element of preparing for tail risks is humility. It requires accepting that no matter how much you study, analyze, or plan, there will always be unknowns. That humility should push you toward prudent behavior, holding some liquidity, reducing leverage, diversifying broadly, and avoiding concentration in fragile assets. Leverage in particular is dangerous in the face of tail risks. What looks safe in normal times can become fatal when volatility spikes. Removing fragility from your system is one of the best ways to withstand shocks. History also shows that those who thrive after crisis are not the ones who predicted them perfectly, but the ones who manage their downside well enough to survive and capitalize on opportunities. After every collapse, assets repress, new leaders emerge, and fresh opportunities appear. But you only benefit from that if you're still standing. That's why risk management isn't about maximizing short-term returns. It's about ensuring longevity through all cycles, even the worst ones. Preparing for tail risks is uncomfortable because it often means sacrificing a little upside in order to avoid devastating downside. But over the long run, that trade-off is what keeps you in the game. In a world that is more interconnected and fragile than ever, assuming the improbable won't happen is perhaps the riskiest bet of all. So where does that leave you? If you own gold or silver, don't rest. Ask yourself, is my holding enough? Is it properly allocated? Are you overweight on something fragile? And if you don't yet own any, now is the time to consider. Because in the years ahead, when people look back, some will say, I knew the risks, I hedged, I protected myself. Others will say, I waited too long. My hope is you will be among the former. Let me leave you with this. Gold and silver are not speculative get-rich tools. They are fundamental anchors. They are part of your financial insurance. When the winds of uncertainty blow, the unshakable things are what hold value, and gold and silver are among them. Thank you. Value your financial peace. Stay humble. Stay diversified. And may your preparations be your safeguard, not your regret.